Selena Hill, the digital editor at Black Enterprise. And today I have a very special guest with me. I'm here with Sekou Kaalund, who is the managing director, head of advancing Black pathways at JP Morgan Chase. And I have him here with me because, as we all know, the coronavirus pandemic has been a sudden crisis that is affecting all of us, especially our communities. But there happen to be a few things that we can all do to protect our financial health in this uncertain time. So before we get to the discussion, Sekou, I gotta ask you, we've all been in quarantine, we've all been on these stay-at-home orders. What is the first thing you wanna do once this corona pandemic actually settles down and comes to an end?
Go on vacation. That would be the first thing.
Yeah.
To be posted up on the beach somewhere. Yeah, that would be great right about now.
Where would you go?
I would keep it close. Maybe Caribbean. Okay. I won't specify an island, but yes, somewhere. The key requirements would be warm and sand, and yes. That really is the only thing that would be important right about now.
That would be so ideal, especially since the weather is still kind of sucky here in the East Coast. But yes, traveling, definitely number one on my list. So, okay, so before we get to the discussion about what our folks can do to protect their financial health, I actually want to talk more about advancing Black pathways. Again, it's a JP Morgan initiative. Can you tell us more about that?
Yes, and before I begin, I do want to acknowledge Black Enterprise, celebrating 50 years. So for all of us on the line right now, they have been providing us and our community with information for 50 years. And I think it's incredibly important to always acknowledge some of these critically important institutions and magazines. So with that, I would say Advancing Black Pathways was launched a year ago. We celebrated our 1-year anniversary last month, really focused on strengthening the economic foundation of the Black community. And we're doing that by leveraging our philanthropic and our business assets to truly invest across education, career, and wealth creation. And so that's where we're anchored. Education, really quickly, we'll focus on everything from a commitment we made to hire 4,000 Black students. Year one, we did over 1,000. So we said over 5 years, we would do that. Financial health for students, careers, the wealth piece is really driven by that financial health and financial education. So I'll talk about some of that in our comments today.
Absolutely. And we know some of the stats around the African-American community are pretty dire. The median wealth of Black Americans is projected to fall to $0 by 2053, while African-Americans occupy less than 8% of national white-collar jobs, and 46% of our college students complete 4-year degree programs within 6 years, compared to 69% of white students and 77% of Asian American students. These stats are so alarming. Sekou, why did Chase feel or decide to become part of the solution?
Yes, and I'll take you around the country on some more of those stats. So if you think across the country, single Black men and women have $200 to $300 versus $15,000 to $25,000 for single white men and women. And then if you look at cities, Boston, Massachusetts, I'll start in the Northeast, the median net worth for Blacks is $8 compared to $247,000 for white families. Now, if I go Dallas, I'll go down south. 35% of Blacks down south in Dallas have zero net income. Atlanta has been our Black Mecca. That's how we refer to it. The statistics there are even worse. And so I can go city by city, whether it's unemployment, whether it's the wealth gap. We really have a systemic challenge to overcome. And obviously this stems from a lot of the historical, that could be a whole separate webinar. But why did we decide to get involved? Well, we have a responsibility to invest in the communities we serve. And when you look at these numbers, at the end of the day, it's critically important for us to create stronger and more vibrant communities. And so we look at this as an opportunity that not only benefits the Black community, but it benefits America as a whole. The greater and stronger and more vibrant our schools, our businesses, our families are, then the stronger the economy is. So we look at it as a responsibility, being the largest bank in this country, that we could hopefully take this leading role and get others to come along the journey.
Absolutely. And that's exactly what you guys have been doing for the past year. Can you just talk more about the success and the accomplishments that the initiative has really pushed forward?
Yeah, so it was a fun and busy year one, but some of the things I'm most proud of on that education front, again, being intentional and setting a goal of hiring 4,000 students in over 5 years and to blow out year one numbers really highlighted the commitment. But not only that, we try to interconnect our pathways because education, career, and wealth are intertwined. And so we look at each of them with a holistic lens. So one of the things we did for students, because 45% of Black students come from poverty zip codes, was we wanted to focus on financial health. So for the first time ever, Howard University had financial health as part of freshman orientation. So all 2,000 freshmen went through this financial health. And we are actually going to be doing that for HBCUs across the country as we digitize this concept. Another thing we're proud of is we launched a hardship fund with our partners UNCF and Thurgood Marshall Fund. And this fund really is to provide grants to students facing financial distress that could likely drop out as a result. Remember, 45% of these students are at HBCUs, over 65% of the students are Pell Grant eligible. And so I was proud to know that this fund helped many students get home in the midst of this COVID crisis. On the wealth front, there's a couple things we do. We've launched Currency Conversation, our effort to reach 20,000 Black women on financial health. That was incredibly successful. So we've started Currency Conversations 2.0, where we're going to be talking about families, couples, et cetera. So just, it's been a busy on all fronts, on all of our career fronts. One of the other things that as a firm we've done that we're amplifying as well is our second chance hiring program. So hiring formerly incarcerated people and citizens to give them that second chance to truly have a career. So all of the education, career, and wealth, we've really made a lot of progress given some of our tremendous partners externally and partners internally.
Absolutely. Yeah, you guys have accomplished so much. And I guess like one of the things our community is concerned about, having that progress actually, you know, kind of go backwards a little bit, especially we see the economy, there's talks of a potential recession, you know, people have their savings on the line, their 401k on the line. So let's just delve into that, because you recently published an article on LinkedIn titled 7 Tips to Protect Your Financial Health During the COVID-19 Crisis. Can you share some of those tips?
Yeah, so one of the first things, back to the statistics we shared, in many cases, unfortunately, we're starting off with less liquidity, less of a cushion. And, you know, as you pointed out, the difficulty around for some of us, if I give you unemployment statistics, in Baltimore, you have 3.3% unemployment, but Black unemployment is 13%. So Atlanta, the same thing, 3.4, and you have 15% Black unemployment. So it was already difficult times for many of us. And so one of the first things you can do is, this is a time where you have to speak up. So if you're suffering from like some financial distress, you've lost your job, call your bank, call your financial service provider, ask them to, you know, either enable you to defer paying. Some of the legislation even covers that, but whether it's your car loan, whether it's your mortgage, et cetera, because the bank won't know that you're going through some financial hardship. But right now, we know as a country, we're all struggling. And so it's important, and these institutions are prepared to work, you know, with their customers. Another thing you can do too is look to automate as much as you can, to auto pay. So in good times and bad times, it's always easy to not have to worry about, oh, what bill do I have to pay? Let me figure this out. So to the extent you use the technology, you know, in your banking app, it simplifies things. And we even have, in many institutions will have this auto save. So a tool where you automatically, it moves the money over, you set it and forget it. Well, if you need to turn that off right now, you know, turn it off and make sure you manage through the crisis, and then you could turn it on when it's appropriate. The one thing I will say though that I don't want people to do if they can afford not to do it. And that is, don't pull back from your 401k and your retirement savings. It's so easy to feel like, I need that money now, let me stop, but you're investing for your long-term and your future. So, again, your own balance sheet. And so I will just say in general, it's important to, not shy away from investing in our future and investing in retirement. And finally, I would say there's going to be a lot of fraud going on in general. So be mindful of, again, cybersecurity, your passwords, et cetera. No bank is going to call you or email you and say, hi, just want to confirm your name and your account number, hang up, because that is not somebody calling for your good, we'll say.
Absolutely. So thank you so much for giving a breakdown of some of those tips. I wanted to actually delve in some of the questions. As I mentioned in the beginning, a number of you guys who are watching now submitted questions via email for Sekou. So Mary Bruce, she said, I have watched my 401k drop over 30,000. When do you think that we can anticipate a shift in the market?
So a shift in the market, it's difficult to ever call the bottom of the market and when we will actually be able to move forward. What I will say, there are two things that will enable us to have a clearer view. One of those would be if they find a lot of people are looking at vaccines and different treatments. If we have some positive momentum with that, then you'll know we're closer to being able to emerge from this crisis. The second thing would just be looking at the numbers. So as we begin to plateau and have a better control of the situation globally, then you'll have more stabilization in the markets and less volatility. But I will say that it also depends on where you are in your life cycle. If you're in your 20s, 30s, 40s, you have retirements not on the horizon, you think that this is going to be long term. So on over the course of 10, 15, 20 years, again, you are going to the market's going to constantly increase. If, however, you're closer to retirement, what I would say is you talk to your financial professional and think about, or if it's in the corporate, looking at how your allocation currently is. So there are some asset classes that may not be as prudent right now. I won't go into the technical details, but rather than, withdraw if you don't have a financial hardship, I would just say, look at reallocating, what you're invested in. If you need to move more to cash, that may be a consideration, but don't react for an immediate or shorter term thing when you need to have the longer term perspective. So for most of us, by just, staying the course, in 5 years, even 10, 15 years, again, you won't even notice that this had occurred as it relates to the growth in your portfolio.
Absolutely. A number of people submitted questions asking about their 401k. In fact, the next question comes from a woman named Patricia. She said, should I reallocate my 401k portfolio towards safer stocks, less risky, or leave them where they are and wait for the market to improve?
Yeah, so it's difficult to answer that question without knowing, but I'll speak in general terms. So generally, yes, I would say looking at if you don't actually choose funds, normally maybe in an IRA you may, but a lot of times you're not choosing individual stocks. But in general, I would always look for quality in this time. So if you're talking about bonds, I would look at high grade bonds versus high yield bonds. So, it can be a shift to quality, but I would say never overcomplicate it and never try to be your own, analyst in that regard. So in those cases, I would, definitely understand what resources may be available, in your company around the 401k, or look at, again, the broader menu. I would say, again, not to be giving investment advice, but, looking at what your allocation is in the context of your full financial, portfolio also is equally important. So a lot of times you don't want to make decisions just on that one thing, but you want to look at your holistic exposure. So I encourage everyone to let this be a moment where you do a financial plan. So if you go into Chase Bank, you're not talking about paying for a financial plan, but you understand, what are your broader financial goals? What does it take for you to get to those goals? And then what you have, how does that position you? And what decisions do you need to make based on what you have in your retirement, what you have in savings, et cetera. And so I think this is a great time for us to make sure we take on that mindset when it's difficult, even to understand holistically what our financial goals are. And another thing I did want to mention around some of the tips is credit. Now, credit becomes critically important, especially in these times. And so one of the things I would suggest, we have this saying, this guy is going to date me, but keeping it 100, keeping it real. But I want us to shift our mindset to keeping it 700 plus, because that's keeping it real. If your credit score is above 700 plus, it will be easier for you to access, different financial instruments. And in this time, you got to take the good with the bad. There's a lot of bad, but the rates are low. And so that is good for anyone who's a homeowner. So you may be able to refi your house or do a loan modification. If it's been less than 12 months, different banks have different criteria, but look at what the rates are. Look at what your current mortgage rate is. Look at the current rates. And depending on when you got your mortgage, there could be significant savings right now. So lowering your mortgage anywhere, again, depending on when you did your mortgage, 50 to 75 bips, which could translate into a significantly reduced monthly payment.
So I'm glad that we started talking about home ownership, because Patricia's follow-up question is, should I continue with my plan to purchase a home in July and August in light of what is happening? What should I keep an eye out for to help me to decide if I should purchase a home late summer?
Great questions, Patricia. I'm gonna give you a shout out for these great questions. So the way I'll answer that again is generally. So buying a home, if you plan to be in that home for a long time, I would say the affordability right now, depending on what market you're in, because real estate varies by place, it's a great time. Because if you're getting a low rate, that same home, let's say the price was even the same, and let's say, in a different rate environment, rates were higher, your mortgage would be higher. So, however, don't feel compelled to buy a house, if without understanding like what the bigger financial picture or goal is. If it were, hey, I'm going to be in this house for 10 years, et cetera, you want to be mindful of again, things can always change. We could always move for a job, but you don't want to go into a house in the real estate market with a plan to have to exit in a year or two from now. That's when you put yourself at risk for having to sell it at potentially, depending on what the market's doing in a recession, if we are in a recession, potentially at a loss. So if you're buying a house and you're going to be in that house, now would be a great time to take advantage of a low rate environment, probably as well some pricing flexibility to really get the home that you want.
That is great advice. We got another question from Donna Howard. It's about a 401k. She says, I lost over $25,000 in my 401k since the pandemic began. What should I do at this point? Discontinue contributing for now and contribute more to my HSA?
So if she's saying the healthcare savings account, I would say again, think about your broader financial picture. Yes, markets are down. Most people's 401ks are down right now. But what you got to think about your time horizon, and you're going to be investing in your 401k, even though there's a lot of volatility right now, at what will conceivably be, when the Dow and S&P were much lower. So you're investing at what again is a close to a bottom, we all hope. And so, but if you continue to invest, and again, you thinking longer term, then you're going to be fine. If you instead, another way to think about it would be, perhaps if I needed to, for my own financial bills, et cetera, to reduce the 401k contribution because I'm making a decision of I need to still pay mortgage or car note or et cetera, that would be an appropriate time to reduce that allocation if it was to ensure that you didn't become, delinquent on something else. But in general, don't look at the red in your 401k as the decision maker on whether you should invest for the future. Because the answer is yes, you should invest for the future. It is hard. It is hard to say, especially because the market had been up so much. So, a lot of people felt like, the best portfolio managers ever. They're like, oh, this is great. I picked the best, let me dust my shoulders off. And then now you're like, whoa. So again, the opportunity, if you look at the broader history of any of these indices, any of these portfolios, the market has grown over time. And so again, my caution is I feel the red. I see the red personally. If it's better for you, if you're not taking out this money or have a specific need for it now, you may not want to look at it. It may be better just to let it ride, because if you have no plans on doing anything with that money right now, then it's just you looking at a screen, right? If you're 3 years from retirement, then immediately go to your financial advisor and talk to them about what shifts you may need to make. But if retirement isn't on your immediate horizon, my best suggestion would be let it ride, because the market over time is going to continue to increase depending on, again, your allocation.
Yep. Great advice there. Thank you for that, Sekou. So we got a question.
Another sad note, though, about the mortgage. So we are at a level of home ownership of 40.6% now for African Americans. And what's disheartening is that's the lowest it's been and equal to what it was when housing discrimination was actually legal. And so home ownership is a critical element. And so for building wealth in this country. And so the one thing, we want to be mindful of is there are programs out there, down payment assistance. All the banks have it. I'm not going to do a Chase commercial, but banks have different programs. Look and talk to your bank to understand what are the programs you may qualify for that may have, again, program money for down payments or something that can be helpful for you as you think about buying a house. So that's the other thing. Look to take advantage of the resources that are available, because there are absolutely resources out there to help first-time home buyers in general, or there are webinars that banks do in communities to talk about home ownership. So I'll give you the perfect example. If you want to buy a home, let's go back to Patricia, in June or July. One thing I would not do right now is, no stores are open, so let's assume we're back to normal and we were shopping. But if you were in your Macy's or Saks or any of these stores and they ask you, hey, do you want to open this credit card to save 10% on your bill? The answer to that may be no, because, when they look at approving you for your mortgage, they're going to look at your credit utilization. They're going to look at how often you've applied for credit. So these are some of the facts that, and we're covering this in our Chase chats that we do in branches. We'll have themed Chase chats on these topics, but those are some of the things you may want to know, because you may inadvertently lower your credit score by applying for a lot of credit before you apply for your mortgage.
And on top
I'm sorry, you asked me a question. I'm sorry.
No, it's okay. I'm glad you brought that up, because even like when you are applying for a credit card at one of these retail companies, don't they pull your credit? Don't they do like a hard pull to even run and do a background check?
Yeah, that is a hard pull. That is a hard pull on your credit whenever you actually apply for credit. So if you look at the credit score, it has different components. So one critical component is your payment history, how you pay, your utilization. So just think about it. I'll give you an example. Let's say I have a credit card, $10,000 limit, and I owe $8,000, and this other person has a $1,000 limit and owes $200. Which scenario do you think has the probability for a better credit score? It's going to be the latter, because the other person has high utilization. They're at 80% utilization of their outstanding credit. So what that would say to the algorithm and the models is that you may be either more distressed or more indebted, so that may have an impact on your ability to pay. So you do want to use credit cards. The other part of the other part I reference is the actual number of times you've applied for credit over the last 4 months. So again, I'm not saying you got to totally freeze out, everything you were going to do. I can't buy a car now if I was planning to buy a car. All I'm saying is you just want to be deliberate and intentional. So if getting that 10% off is that important, you want to still think about it in a holistic thing. Maybe don't buy that, actually. If you're planning on buying your house, maybe look at it and say, this sure will be nice when I get my new house. Put it right back on the rack and keep it moving. That would be my overall advice.
Yeah. Now, there you go. So we got a couple more questions. One from Arena Hooks. She says, my husband and I were just discussing the CARE Act. Although we both are still working, there's a lot of uncertainty. We want to know, is it wise to take advantage of placing our mortgage into forbearance under the act? What negative impact could this have on us financially?
So, again, I would direct people, back to some of the government websites. But what I will say is that banks at this time are willing to work with some of their customers, especially in financial distress. And the CARE Act did have some of that. So what would happen is, yes, you could have forbearance, but the payments don't magically go away. They're added to the end of the loan. And so I would say, if you're in financial distress, your situation better than I do, absolutely, reach out to the bank, to ensure that, again, if you don't make the payment without, consulting your bank, what will happen is derogatory credit reporting, that you are missing payment. So that's something at this time in the act that you could reach out to your bank and have that discussion and definitely take the guidance from them.
Okay. Erica Clark says, mortgage rates have decreased, but when would be the best time to possibly refinance your home given rates might drop again?
So yes, mortgage rates are really at a historic low. And so now we're just talking about how much room they can go lower. At this stage, I'll give you my personal example. I'm doing a loan modification now because I refinance within 12 months. And I locked in on a rate, and I know it's priced off the 10-year treasury. It's going up and down. It may come down. But I said, you know what? It could go up. And I'm comfortable that this is enough of a savings per month over the course of my mortgage that I'd rather move, because you have to also think, if you look at refis, a lot of these banks are inundated with applications, right? And so because of the rate environment. So I would, again, understand what you're trying to achieve. Like what is the objective? Is the objective, I have a 4.5 rate and now I could get 3 1/8, but I think it may go down to 3, so is that 1/8 of a spread worth it, knowing that it could go up to 3.25? So again, in either way, you have to make the decision, is that enough of the savings, or am I comfortable that my rate is 4.5 now, that I'm going to shave more than 25% off my mortgage, 30% off my monthly payment. So if I had 1,000, now my payment's going to be, $600 to $700. At some point, expediency may make sense if you feel like your bigger your objective was accomplished, and that is lowering your monthly expenses. Now, if you felt like, and I don't think this is the case, and I can't be a predictor of rates, if I could, I would still be talking to you, but I'll be talking to you from a different location. I would say the room for rates to fall much more, there's just not as much room. So you're not going to have like the rates where, if you go back a couple of years, 5%, 4%, you're in general not going to get 1.5% 30-year mortgages, right? That's just not. So you got, again, talk to your mortgage professional and your mortgage banker. But in general, it's not like there's this huge amount of room for it to go, right? Mortgage rates, depending on the product, because there's adjustable rate mortgages, et cetera, they're already pretty low by historical standards. I remember when I got my first mortgage, the rate was 6.875, and that was with good credit. Again, it was many years ago, but that was the rate environment. So we've gotten accustomed in the last, 5-8 years even to lower mortgage rates, right? And so our mind is anchored on that. But if you look at a chart of mortgage rates over a 30-year period, again, we're at the lowest mortgage rates have typically been.
Okay. And now her follow-up question is, would this be a good time to refinance a consolidated school loan?
So school loan. So again, anytime where you feel that you can either consolidate your debt to a lower rate or refinance and have a lower rate without knowing any other information, my answer is yes. So if the question is, if by consolidating, I dramatically lower the rate, yes, because it means your principal is going to stay the same, but your monthly payment will change and you'll still be able to pay that off. So that enables you to save money. And I like this question because I think we should be looking at, everything, not just the life debts, et cetera, but savings, what we're doing, how, all of that. This is an opportunity to revisit. And again, don't feel like you have to do it by yourself. Talk to, again, your banker to figure out, but at least have the thoughts. It's easier when people are able to articulate, okay, here's what I'm trying to save for college. I have 2 kids. One is, X and one is Y. I have 3 kids. I wasn't talking about myself. That was just in general. I have 3. I know the ages of my kids. But let's say this fictional person has 2 kids. One is 10 years old. One's 8 years old. So you may then think about, okay, what should I be doing to save for college? And then you could talk about, okay, 5 to 9. Okay, let me make sure, let me understand what makes sense based on what state I'm in, et cetera. So use this as an opportunity to not just revisit pieces of your balance sheet and your budget, but your whole budget. In fact, that's one of the tools I referenced, Budget Builder. Now more than ever, we have a free tool, Budget Builder. The point is, any tool that you have, this is a great time to really look at your budget, understand some of your expenses, and then take the historical look. Most of the credit cards even have this data. And so if you look at your annual statement, some credit cards produce a summary by category where you spent money. So now in this time where we're not commuting in, that's a good time to use to really think about your budget and what tweaks can you make? What can you do differently in the bigger context? So typically it's rather than just doing one product, use this as an opportunity to a broader reset and understanding of what your complete financial picture is.
Sekou, thank you so much for all the advice. As we bring this conversation to a close, what would you leave our audience with when it comes to, again, empowering and protecting their financial health in this very uncertain time?
So what I will leave the audience with is, 1, don't panic. And 2, I'm very sensitive to some of those out here now who may have lost their job. 1, I would direct you to, the resources, understanding your state and federal unemployment benefits, because states and the federal government have extended those. And so they're better benefits than they have been historically. So on that side, I would say, know that there are resources out there. On another side, I would say, don't make decisions based on where you are in the moment. Make decisions based on what your goals are. So don't just take out the worst time to sell out of your portfolio just because you see the red is now, because you'll sell out of, let's say not 401k, but any portfolio at losses, right? If you need the money, that's a different story. But if you're reacting only to the fact that it's down, that is not historically a good time to sell. You like to sell when it's up. And the last thing I would say, just more broadly about, because financial health, it's all interconnected. So think about what we're doing to take care of us. So self-care is critical. Sometimes we talk about, if only I had time, what are those moments? What are those things you've been dreaming about and thinking about that now, unfortunately, due to these circumstances, we do have more time? Everyone should walk away from this situation, and I pray that we walk away sooner than later, but having accomplished something that we were thinking about, whether it was as simple as reading some books to exercising to building out a routine. Let this be a time for us to not only look at our financial health, which is critically important, but our personal health, which has impacts on our financial health. So I would say we should also have empathy right now, recognize that people are going through something. So by you extending grace and being empathetic, you may be helpful at a time when a person's in need. So I ask that everyone here extend as much grace and empathy to others, and because that will help us move together as a society. So I thank you for indulging me. It's been a pleasure to really be here with you.
Yeah, no, it's been a pleasure. Thank you so much, Sekou. We appreciate that. And guys, if you guys want to follow or learn more about Sekou, he's on LinkedIn. He wrote this great article. You can check it out, 7 tips to protect your financial health during the COVID-19 crisis, if you just want to run back some of the things he said. On that note.
Also, one last thing, you could go to www.jpmorganchase.com/ABP, Advancing Black Pathways. And then you could learn more about our broader suite of solutions for everyone, families, businesses, etc. So go to jpmorganchase.com/ABP, or just Google Advancing Black Pathways and it will come up.